Welcome back to Global Money Talk, brought to you by SamProTV. For today's Market Insight, I am joined by Larry Dyer, retired managing director with 40 years experience as a fixed income strategist at major Wall Street firms. He is focused on market behavior and economics. Good morning, Larry. Thank you so much for joining me.
Well, thank you for having me.
Well, here we are a day after the Fed rate announcement with a supersized 50 basis point cut from the central bank. Now, we saw market volatility following that rate announcement on Wednesday afternoon, but here we are on Thursday. We're seeing a rally for the major equity averages, but you have been in the markets for several decades, so give us your assessment of what we got out from the Fed Reserve on Wednesday.
I think they just said, gee, we feel like we're heading for a soft landing. If we're wrong, we'll make an adjustment. That's a horrible TV headline, isn't it?
No, but you've been through many monetary policy cycles.
Yeah.
You've seen various heads of the Federal Reserve, and Chair Powell, he has done this several times, but tell us what's different now compared to before.
Okay, well, Greenspan never said anything. If you understood him, right, he felt he made a mistake or you did. It was more likely you. There was one time the Wall Street Journal and the New York Times covered a speech, and one said he's hinting at easing, and the other said he's hinting at tightening. So it's a hugely different world in the way of, hey, how much transparency do we have from the Fed? They're giving us the dot plot, they're giving us economic projections. There are all of these speeches where they actually say something. Often we're trying to put more of a narrative on it than they're actually willing to make. Right? Think about the market over the past year. We have gone through even 2 years, right? We went through higher for longer, SBB-driven recession, high for longer, and now the current economy is slowing down, and hopefully we're heading for a soft landing. That's a lot more volatility than you see in the Fed projections, than you see in the Fed rhetoric. I always sort of would used to say that the market could probably use some Prozac, but it would be a lot less fun if it had it, because it's going to be moving around a lot. Every month the 10-year note tends to move about 30 basis points. Every year it'll move 100 basis points or more. This year it's gone up close to 100. It's gone down close to 100. The economy didn't move enough to do that. There's papers by Robert Shiller, he got his Nobel Prize for it, saying markets move too much relative to the economy. So if you're an economist, you predict the economy and you say the other economists are right or wrong if you agree with them. If you're a strategist, you might want to think, how crazy can the market get? Do I have a good opportunity? It's more like counting cards, right? If there are a lot of high cards left, you bet differently than if there are a lot of low cards left. And so that's what we'd be looking to do, I think, today. There are a lot of different views in the market, a lot of different investment routines. You can talk to someone who's programming a computer with a millisecond view of the market. You can talk to someone else who runs $1 trillion, and he won't even want to hear any idea that doesn't have a 3 to 6 month horizon, because it takes him that long to make his investment move the portfolio. So those are the moving parts that we deal with. It's more of an inside game, but I think it's very exciting because of that inside game nature of it and how it helps to explain the different moves.
Yeah, and I think, Larry, you highlighted a lot of points there that are important to understand. So for viewers that are watching this today, they might be asking, well, why did we see such massive moves, and why are we here where we are this morning in terms of the equity markets? But let's take a step back, and 2 p.m. yesterday when the rate announcement first came out, we saw the S&P rise at 2:01 p.m. to new record highs, and then it fell down. But then here we are this morning, we're seeing a gain of over 1.5%, and we'll have to see whether or not this rally has legs. But when it comes to fixed income, walk us through what we saw yesterday afternoon.
Okay, well, you came out with, if you looked at the futures market, we were pricing in about a 50-50 chance of a 25 or 50 basis point rate hike. Now, when you get a survey of what is the Fed going to do, it doesn't give you coin toss.
Yeah.
It says 25 or 50. If I flip a coin and it comes up heads, you're not surprised, are you?
No.
If it comes up tails, are you surprised?
No.
If you're in the market, you go, what's the other guy going to think? So for the guy programming a computer, 50 basis points on a 50-50 bet is, in the next few minutes, nobody's going to sell. If nobody sells and somebody buys, what happens to the price? It's very much a micro view of the market. It goes up. If the market shouldn't move more than 5 to 10 basis points from the close on a Fed day, and it's moved 5 lower in yield, do you want to buy, or do you think, gee, it's time to think about selling? And if you think like this, and good traders do, right? If you think like this, you're like, okay, if that's the case, when will I buy? After it's backed up 5 to 10 basis points from the low. What happened yesterday in yields? Exactly that, and it's all explained by this kind of an inside game for the high-frequency traders. What did the guy running $1 trillion, who needs a few months to explain what he's doing, and who's told all the people who gave him the $1 trillion, here's how I'm dealing with the market, do yesterday? Nothing, right? It can't be impactful for his portfolio. Now, what's important for the next few months? The guy with a lot of money.
Well,
So we're looking at this kind of a split.
Yeah, and speaking of the next few months, so when it came to the September rate decision by the Federal Reserve, there was a lot of anticipation, as you mentioned, going into it. Would we get a 25 basis point cut? Would we get a 50 basis point cut? And of course, when we think back to some of the futures and the expectations for the size of that cut, we saw that changing heading into the meeting. And usually Fed officials have that blackout period, but at the same time, we were hearing from former Fed officials, so that was highly unusual as we headed into yesterday's trading session. But we saw that reaction, as you mentioned, and we have to keep in mind that when it comes to yesterday's Fed rate announcement, we got that presser from Powell, but we also got the summary of economic projections and, of course, the dot plot. So tell us about the significance of this on the fixed income market.
Okay, well, I've often used the dot plot as a base case, right? And the reason is it anchors you someplace. You'll hear people talk about, here is the term premium. The term premium, by definition, is how does the market price differ from what the expected Fed rate is. And some people run a computer model for that that looks back 5 years. In the past 5 years, how many different Fed regimes did we have that the computer couldn't look at? So I always ignored computers when I could listen to the Fed, right? So given the dot plot, I'm a geek. I can take those dots and I can price out where should the 2-year note be. And that's a key component because the Fed has a big influence over it. Typically over the past few years, 2-year notes have been in line with the Fed or about 50 basis points below them, below their guidance, because the next big move was going to be a Fed ease. When SPV hit, you were getting 100 basis points or more lower yields on the 2-year note than implied by the Fed. So what does that tell us today? Well, we can look and see, gee, it's probably 2024, 2025, or 25, 50 basis points below the Fed guidance. And that's consistent with the next big Fed move is an ease. And maybe it will be, but if we have a soft landing and the Fed follows through with that, then the front end of the market is a little bit rich. And we can play that game all across the yield curve. I think earlier we were talking about the longer run dot. Well, there's really a dot for each member at the FOMC.
I think we might actually have a chart from our previous guest, Ty, in terms of the dot plot, so we can bring that up if you want to walk us through the differences through the June compared to the June meeting and the September dot plot. So here we go.
Okay, now one thing that happened is, gee, yesterday the Fed changed their mind, but the 2-year note rallied over 50 basis points over the last 3 months. The market changed its mind long before the Fed dots came out, right? If this was new news, 2-year yields should have fallen 50 basis points yesterday. They didn't, did they?
No.
Okay. What happened yesterday was we're dealing with just this little bit of how do you adjust your thought process. So when I look at the chart on the right, one thing that comes to mind is there's a lot more uncertainty, right? On the left, we have most people were in agreement within 25 basis points on 2025, and even in the longer run dot, people were pretty much in the lower end of the range. What's happened is the front end moved in line with what I think market expectations were.
Yeah.
The Fed is not likely to tighten 100. It could ease 100 beyond current expectations. So if you think about that, you pay more to buy a 2-year note that can go up in price more than it would go down. Higher price, lower yield. The longer run dots, there were only the hawks pointing to an above 3% rate in the left chart for June. Now there are a lot of people pointing to a rate above 3%. On the other hand, there are far fewer people pointing to a 250 level, and so it's a much broader distribution to think about. Now that's important because the longer run dot, if we follow this rate path, that might be a big if, but if we follow this rate path, the equilibrium rate could be based off of a 250 Fed funds rate or a 350 Fed funds rate. That's 100 basis points of uncertainty. I tend to discount the super hawkish people, but back in June, there was a 25 or a 50 basis point range.
Yeah, I think it's very helpful to see this comparison with the June to yesterday's dot plot. So as we head into the rest of this year, we'll keep an eye on this and what it means for the markets. But I do want to ask you, Larry, do you see a divergence between the Fed outlook and the bond market overall?
I always love it when there's a divergence because that's when your opportunity to make a profit comes up. Unfortunately today, it looks like the market is priced reasonably in line with the near-term Fed outlook. And the longer-term Fed outlook I'd highlighted is a bit uncertain. That doesn't matter to me for the next few months. And the reason is that there's a lot more trading done with is the 2-year note cheaper rich to the 5-year note or the 10-year note than there is, I disagree with the long-run dot versus the 10-year note yield. Right? We had very high 10-year note yields, 4%, 5% when the longer run dot was 2.5%. Why? Because you'd lose your job before you made money holding a long position in those conditions. Now if I try to build out a yield curve, it looks like it's pretty close to fair value given what the Fed's directing us to.
And so does this imply that there are limited opportunities for investors?
Well, there aren't big opportunities because the big move really happened. We've had a 100 basis point rally. We don't see an indication that we're going to back up this time because the Fed's really endorsing a much more dovish outlook. Before, the dots didn't move. When the Fed moved, the Fed didn't move and the market moved. That's the opportunity potentially to sell, like an SBV earlier this year. Now when they're in aligned, you start thinking differently about what your opportunity set is, okay? I could take a 290 Fed funds rate, say 2-year notes should be something like 320, 10-year notes should be a bit above the 2-year note, that might be 360, 380. Where are 10-year notes today? They're there. So what's going to happen is you'd look for periods where the Fed is a little restrictive, neutral, that's expected to be the case for a long time, and then say, how did the market behave? And my case for that would be 95, 96, 97.
And Larry, of course, we know that without a crystal ball, we can't tell what the future is. So if we do potentially see a hard landing versus a soft landing, what might be the cause?
Oh God, that's a hard one because Yeah, sometimes you can look and say, here's something that seems off. If you go to the 2000s period, you had the internet bubble and a bit of a credit bubble. And when the accounting scandals hit, people actually manufactured earnings and they manufactured cash flow. No one thought you could manufacture cash flow, but with the right accountant you could. So people couldn't trust the accounting, and the corporate bond market had a big hit. In that case, high yield had a big hit. And even though you might have thought the treasury rate was closer to neutral, spreads were so wide that for the private sector, monetary policy was restrictive, and there was nothing the Fed could do. If you go to the housing crisis, it was the same thing. You could see there were cracks in the housing market in 2005, 2006, but the Fed didn't start easing until 2008 aggressively, when the world had already blown up. And so within those contexts, you can look at the market and say, what's out of line today? You can look, and I really don't see it. I see some headwinds, but commercial real estate is often brought up as a topic, but that's mostly held in medium-sized banks. They're important, but they're not as important as the mortgage market, right? And commercial real estate is a moderate piece of those banks' holdings. It's regional, et cetera, et cetera. So within that doesn't quite build up to be large enough to hurt the economy. SBV didn't grow up to be large enough to hurt the economy, and it takes time to go through. So put that in I'm worried about it, but I need 2 or 3 other events or more to really kick in and cause a big kind of a slowdown narrative. Now, one possibility might be repricing the equity market, but we're in a fairly benign environment. So I think people look at this and you start range trading in rates, in equities. You can look to range trade. You might take a little bit of risk off the table or not. But you're talking to people every day. Is anybody talking about here's the really big thing that hits the market and hurts it? When you look back at the housing crisis, with financial reform, you had a lower for longer environment because 2 out of 3 people who could buy a house in 2004 with a mortgage couldn't qualify for a mortgage in 2010.
Yes.
That's a big hit to housing, and it took years and years to fix itself. Right now, I think one of the interesting dynamics is what is the equilibrium rate? If I used my 2004 model, it would be 3.5% to 4%.
Yeah, and so you mentioned headwinds and you mentioned real estate. Of course, we're in a different environment in 2024. We have to consider this event that happened in March 2020 called the pandemic, and that really changed the economy. So when you mentioned the housing crisis as well as internet bubble, hindsight is 2020, of course, but what are other headwinds that
we're seeing pandemic stimulus go away, right? And if you think about how stimulus works, if you give Warren Buffett an extra $1 billion, is he going to spend it or invest it? Pretty much invest it. If you give the average American $1,000, $2,000, they're going to spend it. So the pandemic grew demand, it created bottlenecks, it created inflation. It's funny because the typical American consumer would say, oh, we have horrible inflation. The U.S. actually had pretty good inflation relative to the rest of the world.
Compared to the rest of the world.
But we don't know that. Right? We just focus on here's today for me. But the U.S. had pretty decent performance through the pandemic. What happens next is you have less growth, but maybe a return to trend. Right? You have headwinds like if you have a 3% mortgage, you don't want to sell your home and get a 5% mortgage. You're going to buy a lot less home, given that you're paying the mortgage rate to actually own the home. So that's kind of kicking into a risk that I don't think is talked about is every time we've had a big recession since Volcker, we've had a lower low in long-term rates. So if we have a big recession now, maybe we're getting two handles on the 10-year note yield in the next 5 years, but that's not even a consideration in the next 5 months.
And when you look at housing prices across the country, we saw the spike in not just single-family homes, but also other categories of residential real estate across the nation. And we are seeing some regions across the country fall, but we'll have to keep an eye on those prices, especially as mortgage rates decline in this country. But I do want to ask you, what periods do you see as comparable to today? Are we living in a unique post-pandemic environment that can't be compared to other periods?
If you're trying to recreate the economy by adding up all the different pieces that go into it, it's a bit different because the pandemic stimulus is dropping down. We've had tax cuts which have been beneficial to some sectors, but I think people are worried they're not sustainable. And that could have a big effect, but it's not going to have an effect in the foreseeable future. I would come down to the Fed narrative is rates are currently restrictive and they're moving towards neutral, and that process could take a year to two absent some surprise. That's best characterized by, say, 1995 to 1997, 1998. The market thought the Fed should tighten a lot in 94 more than it did. Mexico, Orange County, and some other events kicked in and said, okay, they've tightened too much. We don't need a 7% Fed funds rate. 6% is okay. They eased to 5% and stayed there for a number of years, which was moderately restrictive. Today we have the Fed easing, but they're not 100 basis points above what they think neutral is. They're 200. So there's a lot more need to ease, but that's already priced into a lot of the yield curve in my view.
Yeah, that is something that's important to keep in mind, because if we think about where mortgage rates were, say, in the 80s before compared to pre-pandemic, the rates were considerably higher in the early 80s. So I think perspective is always important when we're talking about rates.
Well, it's can you afford your home and can you afford the payment on your home?
Yes, absolutely.
And right now, for a lot of people, they can't afford to sell their home and buy a bigger one, or they can't afford to buy a home given where rates are versus historical. It is just sticker shock. Now, you said, what does the world look like? I didn't fully answer your question. 95 to 97, there was a very tight trading range for treasuries. It was a benign environment for corporates. I can remember, funny at my age I can remember things, but I can remember corporate spreads being tight, but no reason for them to get wider. So they were still attractive until they weren't in 98. And for equities, it was the same kind of a situation. I think irrational exuberance started long before the internet bubble burst. So equities can stay rich longer than you can stay solvent. So I'm always cautious with any kind of an equity call. For bond guys, 2 plus 2 is equal to about 4 plus or minus. For equity guys, it's minus 5 to 10. So you have to deal with that higher volatility, and I'm not the expert for that for you.
And of course, you brought up an important point. If Warren Buffett had $1 million, $500 million, or $1 billion, perhaps he might consider buying a new home or a smartphone, but maybe not. So
I'm told he still lives in the same home.
Yes, and drives his old car as well. So that does speak to his frugality, doesn't it? Well, Larry, I do want to ask you one thing. So here we are. We were highly anticipating the September rate announcement, the meeting out from the Federal Reserve, but we have to keep in mind that we are in a presidential election year, and we have less than 50 days until November 5th here in the U.S., so all eyes are on what both candidates say in the run-up to that election date. And not only have you been through many monetary policy cycles, you mentioned some key names there, Volcker, Greenspan, and of course I think of Bernanke as well in terms of Fed chairs. But given that we are in a presidential election year and both presidential candidates are looking to spend more and looking to cut taxes, so what do you think of the idea that tax cuts pay for themselves? Do they really?
I think anybody making that thing probably failed algebra. And that accounts for far too many, I think, economists. Let's do the math.
Okay.
Okay. I know people hate math, but you have to do math if you're going to do a budget, right? Let's say taxes are 30% of GDP. Okay. That's how much the government spends roughly in the U.S. That's federal, state, local, etc. You cut taxes by $1. If tax cuts are going to pay for themselves, how much does the economy have to grow? It has to grow by $3 to sort of pay back that number. Pretty simple math, right? So what does that imply for your return? Well, you're so mad that you're paying 33% in taxes that you're not going to make an investment with a 200% return. If I went to anybody I worked for with that view, I'd be fired in 30 seconds. What if you take a higher rate? Let's move to Sweden. It's 66%. Okay, now that $1 of tax given back has to generate a $1.50 return to be revenue neutral for the government. Once again, that's a 50% return. How many times does the S&P 500 go up 50% a year every year?
We don't see that, do we?
So that just doesn't work. So when you hear people talk about the U.S. credit risk, you can talk about different features. I saw one story today on selling assets. How about you just look at how do U.S. taxes compare to the rest of the world? We're in the lower quartile. So nobody likes it, but I think most people who do the math think taxes go up eventually. I don't like it either, but the alternatives are probably not sustainable. You can look for a Liz Truss moment is probably the best why do rates go up scenario. And funny story, when you talk about elections, politicians change their minds. So if you go back to Trump in 2016, he was going to have huge tariffs, he was going to do all these things. Wall Street forecast a recession. He came into office and he turned out to be stimulative. So rates went up. So I'm very cautious about calling the election.
Yeah, absolutely.
I just want to crawl under my desk and be someplace safe. At the same time, does it change the economic outlook for the U.S.? Not that much. So I think we still look at, for the foreseeable future, this kind of 30 basis point, 50 basis point range trade.
Okay, well, we know when it comes to taxes, whether we're talking about the government or we're talking about consumers, that is a key election issue. So we'll have to keep an eye on what happens, and hopefully we'll know sooner rather than later which candidate ends up in the White House. But before we move away from taxes, some may argue that a lower tax rate actually reduces the amount of money shielded from taxes. So what do you think of that view?
Well, the idea in that is, gee, I don't like paying the high tax rate, so I'm going to put money overseas. Corporations may have a large overseas account. You may see the tax rate fall significantly on that overseas account in hopes that the money will be repatriated. And you know, at the margin, I think you do see some of that. But the common sense thing is another side to it. If you paid if you have sheltered 33 million of income, are you going to say, gee, I'm really happy to pay 32 million of income to the government because that's the right number, I just didn't like 33? It doesn't work. So I think all of the talk on taxes ignores the obvious thing, which is the U.S. is reasonably well positioned to raise taxes. Nobody likes it. You're not going to do it with any foreseeable Congress in my lifetime. But as long as that solution remains, the bond market is going to look through many of the supply features. I can remember that, this is partly a supply story, but I can remember between 2000 and 2007, much of the government ran a surplus. It didn't issue 30-year bonds, it bought them back. what did the market do? Initially, it said, yippee, no more bonds, 10s, 30s flattened, and the market rallied. A year later, 10s, 30s was exactly back to where my models would price it. Why? Because there's a value of the 10-year note versus the 30-year note versus the 5-year note. All of these relationships tend to drive long-term rates. As I said at the start, nobody's betting on a 250 longer run dot when the 10-year note yields 5%. They're betting on a 5% 10-year note looks good relative to a 5% 2-year note.
Well, Larry, very quickly before I let you go, we have only about 60 seconds here, but something that we've all been paying attention to is the yield curve. And some people noticed, given the disinversion that we saw very recently, whether or not this is a recession indicator, but do you lend any credence to that?
Not a lot. You often do get a recession and the market prices it in. But you can also have a period, as I mentioned, that 95 to 97, 98 period, where there really wasn't a recession and the front end of the yield curve was inverted. So a lot of the yield curve inversion stories and how important they are really date back into the 80s and Volcker. Okay, well, Paul could do 300 basis points in a day. That's going to leave a mark.
Absolutely.
And we're not in a situation where the Fed's going to be incredibly aggressive. I think we're right now just pricing out the expectations of what the Fed's doing. If I believe the Fed, 2-year notes might be 20 to 50 basis points rich, but the Fed's more likely to be easing more than it is to be tightening more than its guidance. So maybe that's a fair price for insurance.
Okay, Larry, well, thank you so much for joining me today. That will wrap it up for our interview. Great to have your perspective, especially given all of your decades in the marketplace. Thank you so much for joining me.
Thanks for saying I'm old in such a nice way.
No, I've been through just several market cycles and monetary policy cycles, but it's always great to get perspective from a veteran such as yourself. Thank you so much for joining me. Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro.TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll see you back here tomorrow. Have a wonderful day.